The Fed is signaling a new focus on the extent of rate increases and not necessarily the pace.
It's like the market, at least, is viewing this as more dovish than maybe some had anticipated. What's your reaction?
So to your point, Shauna, the Federal Reserve was really quite firm in both its statement as well as its opening remarks, really just focusing on the fact that the job is not done, ongoing increases, and really emphasizing that they want to make sure that that inflation rate comes back to the target of 2%.
Is the Fed really signaling a soft landing? Are we going to see a less hawkish Fed in 2023? Well, Powell's remarks that 2023 should be a year of significant declines in inflation was definitely interpreted as less hawkish. How is the Bitcoin price and crypto space going to react to it? In today's video, Chamath Palihapitiya discusses Powell's words on inflation and interest rates. So, stay tuned till the end to know if we will get a soft landing or not. And if so, how will it affect the market? But before going ahead with the video, be sure to subscribe to my channel for more videos like this. Let's dive into the video now.
I watched Powell's speech, and it was really amazing because in December, he was extremely hawkish. And he was basically like, listen, we're going to keep rates higher than you like and longer than you want. And that was pretty clear, and the markets reacted. And then not but 35, 40 days later, he essentially said we have 225 basis point hikes left to go. And he's going to try to stick the landing, essentially. And even though the rest of the language in his entire speech and the press conference, if you read it in the absence of his body language, so if you just read the transcript, would seem very hawkish as well. But the reality was he basically capitulated. And then the market essentially said, okay, we're at the end of this thing. And we've talked about this before, but markets tend to bottom 6 to 9 months before it's clear that you could have done this. And so we're a little bit off to the races in the short term. It's compounded by a couple of other factors. One is that at the end of last year, so many people were tax loss harvesting, which means if you had some gains somewhere else, you sold some things that were losing money so that you could net the two together. You saw a lot of stocks. Tesla was probably the poster child for this, trade all the way down to like $108 a share, and it's effectively doubled in the last 30 days, right? So everybody tax loss harvested, everybody degrossed, nobody was really owning anything. And then when Powell basically said we're mostly done, there's been so much systematic buying right now that nobody's really well positioned. To me, this is very similar and eerily reminiscent of the end of 2018 and beginning of 2019. And if you guys remember, at the end of 2018, October, November, December, the markets just fell. And part of it was Powell's going to raise rates, inflation's getting out of control, et cetera, et cetera. And then we got all this data that said China may be entering a real period of malaise, and Powell capitulated, again, trying to stick the landing. And long story short, he didn't. That was a head fake, and the markets just ripped higher. Then we went into the COVID pandemic and all of that stuff happened. So I think we're about to replay a little bit of that, at least in the next 30 to 90 days. The pain trade is to go up. So that's probably where we're going.
Despite his previous hawkish sentiment, Jerome Powell has been calling for a soft landing after the markets have seen some slight relief in inflation. Many economists and investors didn't think the market would be heading for a soft landing after the aggressive interest rate hikes in 2022. Although Powell has declared that the battle against inflation hasn't been won yet, and rates will not be cut, it does appear that a soft landing is coming more than anticipated after the Federal Reserve announced a 25 basis point hike this past week, and a very high possibility that the next rate hike will also be 25 basis points. They are slowing the pace of rate hikes as inflationary pressure seems to be easing. In Chamath's view, the market situation seems very similar to what the market saw in 2019. He adds that markets usually bottom a few months before everything is clear. So, is this what we've been seeing right now? What do you think of Chamath's thoughts here? Do you think a soft landing by the Fed will lead to the market ripping to the upside? Let me know your thoughts in the comment section below. Also, be sure to like and share.
I think the marginal risk here is for this whipsawing. So we have a period now which is disinflationary. But the problem is if the stock market keeps going up and all of a sudden we have less restrictive monetary conditions, then we're going to be back at the same place we were before, which is money sloshing around into all kinds of risky assets or more money. There's still an enormous amount of money sitting on the sidelines that has to come into the market now if this thing keeps going higher. So we're in a delicate moment. And if we reignite inflation because all of a sudden more companies have more liquidity that they can tap, right? More money they can raise, more money as a result that they can spend, because we don't have this first inflationary cycle under control, there could be a risk that we reignite inflation. And so then they have to capitulate, the Fed has to capitulate again and start another hiking cycle. So I think it's a complicated moment. I think all of the smart money in Wall Street that I talked to up until this point, they forecasted like this period would be choppy and the second half of the year would be really robust and like you needed to be super long and things were going to be incredible. And when I talked to them this week, they're like, oh God, we weren't positioned for this. We had no risk going into this. We're going to be forced buyers. There's a bunch of companies that are whispering that they want to go public now.
Oh,
and
really?
So the big banks have been calling around trying to book build quietly for some IPOs. And so if they try to kind of crack this capital markets open, I think there's, again, the marginal risk will be that we do whipsaw aside.
The United States Federal Reserve announced that it would begin the process of slowly raising interest rates. The Federal Open Market Committee lifted its benchmark rate by a quarter percentage point to a range of 4.5% to 4.75% on February 1st. Powell essentially emphasized that while disinflation has started, there is still a long way to go, and more increases will likely be required if the labor market remains robust. Investors now anticipate that the rate would climb to a little beyond 5%, in line with what Fed policymakers predicted in December, in response to January's hot employment report. But one message from Powell to the market that raised optimism perhaps for the year ahead was about disinflation. There has always been uncertainty about how rising Fed rates will affect the market. Inflation in goods has dropped significantly, but until disinflation has spread more broadly, the Fed will remain committed to tighter monetary policies. Chamath also highlighted that inflation has been low for some time now, but if it gets reignited all of a sudden again, it could start to rise rapidly. And this would be a difficult moment for the Fed, as it would need to make a decision about whether to allow inflation to rise or to start tightening again. The Fed has said that it will proceed slowly and carefully, but only time will tell how this will affect the economy. Let's get into the next clip to hear more from Chamath Palihapitiya.
We have to think about is like most of the market are not people, right? Most of the market are computers and algorithms and ETFs. It's an extremely formulaic buying model. You have components of an index, those represent certain percentages. You have to own those percentages to be relevant as that index. And so it's this reinforced buying loop as well as a reinforced selling loop, right? So when things start moving, those folks have to just systematically move money in. All the humans know that. So the humans tend to front run all the computers, and they basically are the ones that sell into these guys. And then that's what inflates these prices. And similarly, on the way down, humans try to front run it by being short into that stuff. So we could see the capital markets open. Even if we don't, it's actually the worst scenario because now you have all this money going into a fewer number of names. That sort of explains Facebook has doubled in 30, 60 days.
Yeah, I was about to get to that. Yeah.
Tesla has doubled in 30, 60 days. A lot of the tech stocks, like high beta stocks that we are all, helping to build, those companies have just absolutely ripped 60 to 100%. These are not healthy and normal moves. And so the question is what happens if inflation somehow all of a sudden pokes itself back up? Right now, it doesn't look like it is. And
Fed Reserve's head Jerome Powell said that inflation is going to ease now. He also said that the interest rate could rise more than the market expectations if the economic data doesn't cooperate. The U.S. Fed increased rates by 0.25%, bringing its total rate increases to 4.5% over the last year. While this move was widely anticipated, market forecasts have diverged from the Fed's telegraphed policies as far as future rate decisions are concerned. Chairman Powell reaffirmed the Fed's forecast in which more than one additional rate increase will likely be needed to bring the rate of inflation down to a target rate of 2%. So what are your thoughts on this? How will the market be affected by the Fed's decision? Is 2023 going to have a soft landing? Let me know your thoughts in the comments section below. For more videos on economy, crypto, and markets, be sure to subscribe to my channel. Also, don't forget to give a big thumbs up to this video. I'll see you guys in my next video. Adios, and thanks for watching.